Hello and welcome. This is the earnings special on Bloomberg Quint, and we are taking stock of earnings from Justdial. Well, the earnings are steady, certainly, especially on a year-on-year basis. But if you consider it as against expectations, it's turned out to be a mixed quarter. To take us through this quarter and what we can expect going forward, we're in conversation with Abhishek Bansal, the CFO of the company. Abhishek, good morning and thanks for taking the time out. Let's start off with your assessment of the quarter. From what we read is that, well, the top line was aided largely by other income. And of course, that led to margins expansion, but that was also on account of costs being cut. Let's just talk about your growth, your top line growth for now, and we can talk about your margins a little later on. What are you seeing in the quarter and how are you assessing?
See, last quarter, from our particular perspective, the first metric that we look at is how has traffic been panning out, because that reflects the usage of our product. Overall traffic grew about 23% year on year to about 160 million quarterly unique users, which is extremely healthy. Mobile traffic alone, which contributes more than 80% of the traffic, grew 29% year on year to about 130 million users. So traffic trends have been quite healthy. On the revenue side, operating revenue grew about 9.7% year on year to about 243 crores, which was due to 12.5% growth in paid campaigns, which again is a healthy sign. So from our particular perspective, we are trying to ensure that all the key operating parameters should be healthy. And as and when there is some particular recovery on the ground in terms of better prospects for SMEs, I think we as a company should be a beneficiary of the same.
Okay, Abhishek, what we're also reading is that there has been low realizations. Of course, realizations in compared to estimates, especially when it comes to well, paid campaigns. How are you reading into this? Is this largely on account of the slowdown in the economy, which may have impacted to a certain extent, well, some of these variables for the company, or is this just a one-off quarter? How are you reading into this?
Realizations ideally are expected to be on a decline for us because the share of tier 2, tier 3 cities is increasing, where our ticket sizes are lower. Tier 2, tier 3 cities contributed about 30% to our revenues and 50% by count of our particular paid campaigns. So it is expected that realizations ideally should be on a decline.
All right. Well, Abhishek, can you tell us a little more about your expectations from traffic then as we move into the next couple of quarters? What are the trends suggesting? What are your expectations here?
So on the traffic side, traffic I think is a function of 2-3 key parameters. Firstly, what kind of improvements we keep doing in our product. Recently, we have released the revamped version of our particular mobile site, which is quite slick. The same will be reflected in our apps shortly. At the same time, advertising also helps us grow our particular traffic. So both these particular parameters, I think, should help us maintain our 20% plus year-on-year growth in overall traffic. And the mobile component should continue to grow at a healthy 25 to 30% year-on-year going forward as well.
Okay, Abhishek, I also want to get an update on the pricing now when it's pitted against volumes. What takes precedence over the next couple of quarters?
The key focus for us obviously is the overall revenue growth, which is a function of 2 parameters, paid campaigns as well as realizations. While we try to ensure that we maximize on the revenue growth first, but in this particular current environment, we focus more on the volume front because we realize that it is important to have more number of SMEs being associated with the platform in terms of pricing or the value per customer that you can always drive up once the economy is more supportive. So at this point of time, it's the paid campaign growth that will take precedence over realizations.
All right, and a final question then, Abhishek, is to do with the shift of business mix in tier 2 and tier 3 towns. How is that panning out, and well, how has that had of course, what sort of an impact can it have on realizations going forward as well? You've already mentioned that realizations are expected to become lower considering that shift, but if you could give us a further elaborate on that point.
So tier 2, tier 3 cities, obviously there is a significant scope for us to penetrate those under-penetrated markets. There is a scope to grow realizations as well. So whenever we enter a particular new territory, we enter it with a very bare minimum pricing because we want SMEs in that particular geography to quickly come and try our particular product. Once SMEs see value in being associated with the platform, you can always increase pricing at a later point of time. So tier 2, tier 3, which contribute 30% by revenue and 50% by volumes, they are expected to continue to be growth drivers for the company going forward as well.
Abhishek, we'll leave it at that. Thank you so much for joining us and talking to us here on Bloomberg Quint.